Hello to everyone watching. My name is Mavani and welcome to another episode of The Link. In this video, we will chat about some of the events that occurred in the global market this past week, including interest rate decision from China manufacturing data, US labor market, and some specific companies. So let's dive right into it. We had a good performance in the global emerging and developed markets over the course of January 2023. And our focus will be on the S&P500 and the Nasdaq 100 indices, which are both available as EFTs on Easy Equities and Cetrix. The S&P 500 index tracks the top 500 listed companies in the US. It is usually used by investors to track the overall stock market and as a leading US economic indicator. The Nasdaq 100 index includes 100 of the largest non-financial companies listed on the Nasdaq stock market. Most of the companies here are large tech companies such as Amazon. The S&P 500 index returned 6.2% to its investors in January, while the Nasdaq 100 returned 10.6%. Both indices continued strong into the first few days of January to close the week a few percentage points higher as indicated in the chart. There are a lot of reasons for this performance, many of which we have spoken about in previous episodes. First, we speak about the inflation data that came out of the US, which is going in the right direction. Investors saw it as a signal that the Fed would slow down the pace of the interest rate hikes. This is definitely a positive signal, so the indices rallied. Then this past week, the Fed actually did slow down the pace of the interest rate hikes, which further encouraged investors. If you look at the chart closely, you will see that both indices traded slightly lower towards the end of the week, as concerning results were published by the companies included in these indices, which we'll touch on later on this video. The US, the Eurozone, and UK all announced further interest rate hikes this past week. As I mentioned earlier, the market was really encouraged after the US Fed slowed down the pace of interest rate hikes by announcing a 0.25% increase. And this is after they increased the interest rates by another 0.5% in their last meeting. Both the ECB and the BOE maintained the pace of their interest rate hikes by announcing a 0.5% increase in their respective rates. Both institutes indicated that they are still concerned about the record high inflation experienced in their countries, even though they have started to move in the right direction. Some investors are starting to worry about the higher possibility that the UK may go into recession in the year 2023. The chart on the left shows how fast interest rates have increased since the start of the cycle in September 2021. Some institutions, like the European Central Bank, started their cycle later than others, but all have seen quite aggressive increases in the short space of time. This is highly burdensome for the average consumer. The US unemployment rate hit the 53-year low at 3.4%, down from 3.5% as the labor participation rate increases. This is a lot higher than the economists expected. Average hourly wages were also published, which increased by 0.3% in January. This lowered the year-on-year increases in wages to 4.4%, which is still strong. If you look at the chart on the bottom left, it is still higher than pre-COVID level as shown in the years before 2020. This is good for workers as consumers are under pressure. However, the Federal Reserve Bank indicated that they will be watching these data points when making their interest rate decisions. Even though inflation is going in the right direction, if the labor market remains strong, the Fed may continue to raise interest rates. This is why US market declined when the labor news came out. Knowing how the market will react when certain data points are announced is very important for freelance investors. PMI is a monthly survey of purchasing managers in each region. The index provides leading indication of business confidence A reading above 50% indicates the economy is expanding, and a reading below 50% shows that it's declining. If you look at the chart, you will see that the Eurozone PMI indicated an overall activity increase in the month of Jan, despite having been in contraction for the past 6 months. Activity in the US also saw an uptick in January. Unfortunately, the UK saw a decrease in January, which affirms the investors' concern of a possible recession in the UK. Business and consumer confidence are key things to look out for as they become leading indicators for how overall economy is doing. Data points such as inflation rates and the GDP growth are only historical data. As indicated earlier, the PMI is an indicator of economic health. The manufacturing PMI is based on 5 major indicators: new orders, inventory levels, production, supply deliveries, and the employment environment. The Chinese manufacturing PMI in January was at 50.1 points, indicating expansion for the first time in 4 months. The manufacturing industry in China impacts some of JSE companies, since these companies export to China. Expansion is definitely good for export orders. Non-manufacturing PMI in China was even better, at 54 points in January. This is also the first expansion for the service sector in 4 months and is indicating a strong consumer confidence. In this week's local market wrap, we covered the JSE performance over the month of Jan, some manufacturing and new vehicle sales data that was published this week. We also covered the operational updates published by some of the JSE listed companies this week and tied it into some of the themes we have been discussing in all our episodes so far. We've linked the video above, so tune in and find out more. So now let's get into the specific company news. Our focus is on the big tech companies that reported last week. All these companies are part of the Nasdaq 100 index that we spoke about earlier. Apple reported results for the first quarter, which ended December 2020. A 5% decline in sales, which is rare for this company and was therefore worse than what the market participant expected. This was after one of their factories in China was shut down due to COVID last year. Amazon reported relatively strong sales growth of 9%. However, what spooked investors was the outlook statement from the management team was that they expected trading in the next quarter to slow down from this level. Amazon's last month's report that it will lay off around 18,000 employees as it goes into a tough economic condition. Meta also reported weak results in the quarter ending December 2022. They reported a 4% decline in sales, a 55% decline in profits. In November 2022, Meta announced that it will lay off 11,000 employees. What made the share trade higher is that they announced a 40 billion share buyback program. A share buyback is when companies buy their own shares from the open market. What this does is reduce the number of shares being traded in the stock market, which pushes the share price higher. Alphabet also reported weak results for the quarter ended December 2022. They reported a 1% decline in sales for the first quarter. For 2022 financial year, they reported a 9.8% sales growth. However, this was coupled with 21% decline in profits as costs increased significantly. The company announced that it would lay off 12,000 employees last month. It is very interesting to see that the labor markets in the US continue to be strong even after big tech companies have announced significant layoffs. It's time to think about your investments in the context of the 2 videos we've uploaded this week. What themes are we seeing in China? Think about what we said about the industrial mining companies in South Africa and their reliance on exports to China. What decisions are you making regarding your investments given these given these developing themes. We split the global and the local market updates into 2 videos this week. Make sure to tune into the local market wrap, where we touch on various topics that shall help you refine your investment decision. Do like, comment, and subscribe. See you again on the next video.